Hey, Scott Phillips here, the Motley Fool's Chief Investment Officer in Australia, and welcome back to Financial Literacy Week. This is Hump Day, day 3, Wednesday. We've made it almost halfway. About half an hour's time, we'll be halfway through Financial Literacy Week, which is a blessing and a curse. I'm really excited to bring you lots of great information. So is the whole Motley Fool team, by the way. I say I'm the bloke in front of the camera because God knows why, but I am. But the rest of the team have done a heap of work to get this ready for you and deliver for you. So I'm excited to deliver it. I'm very, very, very proud and pleased with the team I have working with me to make sure we can deliver what is hopefully a useful financial literacy week. G'day, Hassan. Thank you for joining. Phil's, I said, day 3. So what have we done? We've done myths and mindset, right? We've hoped, if you haven't seen these, don't stop watching. Go back and watch them later. We've tried to unpack some of the reasons people don't invest, some of the reasons they should invest, some of the things that we can hopefully clear up for people to give you the best chance of saying, you know what, investing really is for me. Money management is for me. I can do this, right? And you can. It is absolutely possible simply by saying, you know what, a bit of self-discipline, a bit of planning, some tips and tricks, and some goals and ways to get there. That's what it takes. That's what hopefully we're going to deliver all this week. We started with that on Monday. Yesterday, we talked about budgeting and debt. That was the Eat Your Broccoli one, and thank you. I can't remember who it was. Someone left a broccoli emoji on the live chat at the end. Thank you very much. I appreciated that very much. It was kind of I'll say tough love. It wasn't too tough, but it was here's what you just need to do. I can't make magic. You can't make magic. Money makes money, as they say. The first bit of money you got to save yourself and work for, earn that cash, save that cash, and put it to work. Hopefully you got some good value out of that, some budgeting tips, some budgeting tricks, some approaches, mental, emotional approaches to budgeting. And at the end, a bit of a reminder not to get in debt, as well as the importance of putting together your financial emergency fund. The money, rainy day fund, call it what you want. The money that's there if and when you need it, which is held in cash in a high interest term deposit, not in the market. Why? Because you don't know when you're going to need it. And you don't want to be selling accidentally or unfortunately, coincidentally, when the market's down, right? So keep that in cash, because then you know the money is going to be there when you need it. All right. Let's do a couple of quick housekeeping things. Firstly, I'll say this every day this week, unless I forget, in which case someone will yell at me. I can only give you general financial advice. The Motley Fool is a licensed financial provider. Now, please only ever take advice from licensed providers, not because they're infallible, just because they've at least had to qualify. They're convinced the regulator that they can give financial advice, and also that they've done the courses and the learning to make sure they actually know what they're talking about. It's not to say others don't, but in case of financial advice, I guess you'd probably rather know that someone has the quals rather than not. I hope. Is that self-serving? I guess a little bit. It's painful to get a financial services license, by the way. So other people are like, you know what, I'd love to, but I just can't afford it or can't justify the time and effort. So it's a bit self-serving. It's a bit of a closed shop. And there are some bad financial advisors out there, right? There are not many, but there are. But generally speaking, if you at least start with someone who's done the work, got the license, kept the license, that's useful and important. I also called you fools at the beginning. We say that with absolute love and charity, because being a fool, a motley fool, excuse me, in particular, is about, well, it comes from Shakespeare. For those who know their Shakespeare, the Bard wrote about the motley fool. He said, as you like it, by the way, was the play. A fool, I see a fool in the forest, a motley fool. Now let's unpack that a little bit for you. Motley being multicolored. Fool was a Shakespearean term, the term of the time for the court jester. So imagine the multicolored court jester. You can't see it in the back. I've got a jester's hat up there. I might get it out later in the week if you remind me. And the idea of that was that the court jester, the motley fool, was the only person in the king's court who could tell him the truth. It was just kings back then, who could tell him the truth without losing their head. Do it with a bit of a laugh, hopefully some home truths, and in a way that didn't actually confront directly the king. Now, maybe I've been guilty of being a bit more direct than the motley fool of yore. That being said, I'm not talking to the king. I'm not in danger of having my head separated from the rest of my body. So I hope that's been a safe thing to do. Why was the motley fool chosen as our name? Well, for that reason. To be able to speak truth to power. To be able to say the things out loud that other people can't say or won't say or aren't allowed to say. And by the way, we're started by two English majors, Tom and David Gardner, back in 1993, which feels like yesterday, but they tell me it's a long time ago now. Started the business. Now they had finance in the family. They'd been taught by their uncle and their old man, I think their grandfather maybe, how to invest, and that's kind of useful and worth doing. So they had some insight into what they were doing. But the idea of kind of being the outsiders, those again who could speak truth to power, no vested interests, and to this day, the only people who pay the Motley Fool any money are you, our members, if you are a member, or We get a little bit of advertising dollars, some on the website, some on the podcast, a little bit of ancillary stuff. By the way, that advertising is done without fear and favor. So I do most of the voiceovers. So trust me when I say I've done ads for companies I wouldn't recommend either as investments. We don't get paid to say a thing as an opinion. I'll read an ad, but it's an ad when I do it. That helps to pay for the podcast. But other than that, that's what we're here for. That's what we do. So that's a little quick short history. I thought on day 3 I should at least give you that sense of it. When I call you a fool with a capital F, I'm giving you a massive compliment. I hope we are trying to speak truth to power, trying to be, and not for the sake of being contrarian either, by the way. We're not the conspiratorial sorts in the corner, in the shadows, kind of yelling at how terrible everything is. We base it on hopefully some reasonable insight and information. The most important one is you can do this. That's the most important one, right? Some in our industry are not, well, for explicit or implicit reasons, deliberately or subconsciously, will say, you know what, I'll do it for you. It's okay. It's really hard. I'll do it. You just pay me and I'll do it. Now, we take money, by the way, for giving you stock advice, but we don't make the trades for you. We don't handle your money. You can do it yourselves. If you decide you don't want to use our services, you simply don't renew your service and you go away. And if enough people do that, I get a new job, preferably not as a YouTube influencer, but that's the way the business works, right? So we only survive if you make money. Brokers make money when you trade, by the way. Financial advisors get paid as a percentage of your assets, some of them. They charge you an amount of money anyway. We get paid a renewal, a membership, a subscription, if firstly you think it's worth signing up for, and secondly, if you think it's worth hanging around. So that's the Motley Fool for you. G'day, Peter. Thanks for coming back. G'day, Michael. Any thoughts on AX1? I might do stocks a bit later if I've got some time. I can talk, Michael. So if I get back to it, remind me. If I run out of content towards the end of the hour, I might do AX1. Actually, you know what? Bring that one for me on Friday. We're going to do a masterclass and a Q&A. The masterclass is going to be about a bit of a recap, and then the Q&A is like floor open. Please hit me with your questions. So I really, really, really want lots of questions. If they're company specific, great. If they're about investing, great. If they're about my favorite football team, I'll talk about the Roosters all day. So feel free to do that as well, but probably investing. Gordon, g'day from SA where the sun is still shining bright. Mate, can I tell you, yesterday here was 16 degrees. I'm in Barrel in the Southern Highlands of New South Wales, halfway between Sydney and Canberra. Out there right now, sun's out. It's blue sky. So I'm in here because I love you guys, not because I want to be inside an office. I've even got the blinds down so I don't look weird on camera. I will get back outside hopefully after this and have a walk in the sun. Naomi, g'day, thank you. Naomi and Hannah, awesome. Thank you both for joining in Sydney. Excellent. My old stomping ground. I'm a Sydney boy, born and bred. So thanks for tuning in. As a reminder, quickly too, actually, wasn't going to do this, but I will because there's 2 of you there, and I love that there's 2 of you watching. If you have friends and family who'll benefit, if you're watching this, I hope you'll benefit from it, right? I really hope it's useful. I hope you'll learn some stuff. I hope you'll be reassured about some stuff. I hope to repeat some stuff. I had a conversation with our team this morning, and we talked about a book I read recently called Same as Ever by Morgan Housel. He's actually an ex-Fool. So a friend of the Fool, and we love Morgan. He does great work. His book is pretty much nothing new, right? It's not a single new thing, well, almost not a single new thing in it. He won't mind me saying that. That's the point of Same as Ever. And so I kind of said to the team this morning, I read the book and I actually put it off for a while. Sorry, Morgan. And I put it off because I went, well, I know all the stuff. But there's something about, I liken it to the Berkshire Hathaway annual meeting. Warren Buffett runs that company. You might have heard of him. I own some shares in the company. He has an annual meeting every year, and he says almost exactly nothing new every year. Why? Because he's been doing it for 60 years. He's told us all the things. But why do you go for the same reason you go to church on Sundays? I don't, but some do. Just to have your I'll say faith in this case, but whatever ideology, whatever view, whatever approach, whatever you're into and however you're doing it, to have that reinforced. Yeah, that's right. I remember I should do it that way. When you read a great book, reread a great book, you take those new things out of it or get stuff reinforced. That's kind of what we're trying to do. If that's you, then awesome. Thank you so much for spending the time. If it's not you, by the way, then welcome. Thank you for spending a bit of time with me, trusting that I'm going to help you hopefully get control of your finances and start investing. If it's either of those 2 though, and you have friends and family who'll benefit, can you flick on the link for the original video and the series? I don't think we're even putting ads on this one, so I don't think there's a single cent we make out of it. If people join up to our services, that's awesome. So again, we can, I guess, indirectly make some money out of it. But I just want them to kind of learn from it. Once it's on the internet, it's there forever, for better or worse. I'll mind my P's and Q's. But if they can benefit from it, just do them a favor. Even if you tell them, look, don't even start like fool. Just watch this, right? I hope they do. But if they don't, I don't care. We're doing it because we want to help people, not because we're trying to make money. We do that with other parts of our business, and I won't say shamelessly. I'll say unashamedly, because we're here to make money. We're here to make money by helping people invest. So that's kind of what we do. But we also try and do stuff. Most of the stuff I do is this sort of educational stuff. So if there's people who benefit from it, friends, family, nieces, nephews, sons, daughters, uncles, whoever, friends. If you flick them the link, if there's better links out there, send them those instead, by the way. But if you found this useful or interesting, please send them those links. Naomi, yes, Johanna's manager. Oh, that's really cool. I love that. That is so good, Naomi and Hannah. Thank you both. That is really, really, really cool. Cassandra, thank you for chiming in as well. Thanks for coming back. That is awesome. So yeah, look, I love that, right? Do that for someone, pay it forward. I don't know. The world's a wonderful place, but it can be a bit dark sometimes. Just do someone a favor. Random act of kindness, right? Send them a link. Say, hey, if you don't watch it, I don't care. If you do watch it, I hope you'll get some benefit from it. But if you don't, that's cool. And by the way, Hannah, if I screw this up and you hate Naomi for making you sit through this, and I apologize in advance, we'll have to. I'll make it up for you somehow. All right, that's enough talking. Let's get on. Well, it's not enough talking. Another 50 minutes of talking. How lucky are you? We're going to talk about Practical Investing 101. That's the topic. As always, my computer screen is down here. The screen that shows me what's on the camera is over there, as is the chat, the YouTube chat window. So I'm going to have to look backwards and forwards, and apologies if I do. There's no one else over there. I'm in the room by myself, for better or worse. But yeah, that's where that screen is. So that's why I'm doing that. All right. I mentioned on, I think it was Monday, might have been, yes, I'm pretty sure it was Monday, that when I was a kid, my dad said the stock market is a casino. That was the view. Now go back to 1980 something, don't ask, and I won't tell. Telstra hadn't been floated. The big banks, Commonwealth Bank might have been. I think Woolies still hadn't been. It's a very, very long time ago for the young people. I get it. Why I'm saying that is because to some degree, Dad didn't have the advantage we have now of having 40 plus years of knowing more about the stock market. It's become much more part of our everyday lives. But there are still plenty of people out there, lots and lots of people, who see the stock market as a casino, or they see it as the smart money, or they see it as something that, is the big end of town stealing money from the small end of town. All those things, all those kind of tropes, they actually are a little bit true around the edges. And this is why they become like that, right? What stories do you hear in the paper? You hear 60 billion wiped off the stock market. That feels bad. You hear dodgy businessman goes to court for thing X. We've seen a couple of those in the last 12 months. You see the Christopher Scases of the world absconding to Mallorca. Again, old reference for those people who don't remember that one. You see companies going broke. And you think, hang on, well, this is all happening. Meanwhile, the rich are getting richer over there. This seems like a terrible idea. Why would I do this investing thing? And I'm here to tell you that over time, the market average, and I'll get back to these things later, but the market average has been about 9% a year. I mentioned this earlier in the week as well. And that's the 9% that you get regardless of who you are, what you do. If you got the average market return, you got 9%. Now, yes, some people got 12 and some got 5. That's absolutely true. I'll help you try and avoid the 5 and move towards the 12 a bit later. But that's absolutely true. But as a whole, as the market, it has generated 9% per year, compounded for more than 100 years, right? This is a wealth creation machine. It always has been. I can't promise it always will be. I'm not allowed to. I wouldn't. I suspect it always will be. My money literally is on that fact because I invest. That's what I do, not just for other people, but on behalf of my own family, my own money. I've got a house and a share portfolio and a couple of used cars. That's where all of my investment money is going. I'm just going to turn this sound off because I'm an amateur at this and I had the speaker still turned up. There we go. Go away now. I don't know if you're hearing that ding, but I was. So on the off chance you are, I'll turn it off to stop avoiding, to avoid distracting you. So the stock market has created massive amounts of wealth for decades and decades and decades. You'll also hear people, by the way, say, the crash is coming. So it's been good for the last 10 years because. It's been good for the last 20 years because. Yeah, okay, it's been good for the last 35 years because. And here's the thing. Pessimism sounds smart. It just does, right? Oh, I'm worried about this thing. You go, oh, really? Tell me more. If you say, the world is a wonderful place, everything's awesome, we're all going to be great. You kind of go, there's the nutter over there. Here's the thing, optimism wins. Optimism absolutely wins. It builds value because people make things, they meet wants and needs. I've said this already this week. They meet wants and needs for people and businesses. They find better ways of solving those new and existing problems. It creates value. It just does, right? And again, I can't promise it always will, but I don't know why it would change. I don't see any reason for it to change. And by the way, if you think it will, John Templeton, a famous investor from a century ago, said the four most dangerous words in investing are, this time it's different. It almost never is. So just keep, both ends, by the way. There's people say, it's going to go to the moon. And, it's going to crash. Yeah, no. Markets are volatile. I'll get back to that as well. What is the stock market? So let's take the casino out of it for a second. When I say it is on the edges, by the way, what I mean is some people try and scam you. Some people do try and use it as a casino, put their money on black or red and hope they win. It's possible to win. It's also possible and probably you'll lose a lot of money. But you can pretend it's a casino if you choose. I wouldn't, but you can. Doesn't mean the market is a casino in and of itself. It's how you play the particular games. So what is the stock market? Well, it started a very, very long time ago. I'm not going to give you a full history lesson. Don't worry about that. One of the great innovations of modern commerce was what they called the limited liability joint stock company. I'll break that down. Before that, so let's start where you were, and I'll tell you why it was an innovation. Before that, if I started a business, let's go with ancient Uber, right? I got a horse and cart, and I offered people to pay me $1 to take them from somewhere, point A to point B. When I did that, I was the owner, the sole owner. There was no other option. You could have an informal partnership, but effectively there was no companies or corporations. So I owned the horse, I owned the cart, I did the work. If there was a problem, if I caused some injury or something else went wrong, I was personally liable for that. As the owner and the operator, I was on the hook for all those things. Now, some would say that's reasonable, and we'll get back to that in a minute, but it meant, everything was on the line. If I got sued, my house was on the line. Again, I don't know if people got sued in 1600, but I assume it's possible. Anyway, I was on the hook, right? If I screwed up, if I did the wrong thing, I was personally on the hook, and it was not only was I on the hook in terms of my business, but all of my other assets came with it. Let's go to the joint stock bit. If I wanted to grow my business, I had to either try and find someone in the town square to lend me some money to buy a second horse and a second cart and to employ somebody, or I had to try and save that money myself. Now, that meant things were really, really slow, right? How much capital was available for loan? When did it have to be paid back? The rules of a loan are very different to owning shares, because shareholders don't get to say, I want to be paid back. You buy the shares, you own them, you own a share of the company. You don't have a debt. The company doesn't have a debt to you. You're an owner. So there is no requirement or obligation for them to repay a loan. So that made things really hard. Fast forward to what I just said, the limited liability joint stock company. Limited liability being your exposure if you do the wrong thing or something goes wrong, is now limited to only the value of your shares. If Woolies goes broke, the people who Woolies own money, it's not going to go broke, by the way. The people Woolies owe money to can come back, can go to Woolies and say, I want the money, and they Woolies say, well, my bank's empty. They can't then say, yeah, but Scott Phillips, you own shares in Woolies, I'm coming to you for the money. So the liability stopped at the corporate level, doesn't go to the owners of the company. And joint stock means you can have more than one shareholder. Joint stock, and stocks, shares, same thing. Joint stock company. You can say, well, actually, I don't want to borrow money from you, but hey, Bill, do you want to invest with me? Do you want to, if you give me 100 shekels, I'll keep my shekel thing, we can buy another horse and cart, and we'll be twice as profitable, and you'll earn some money from that, and that'll be worth your while. And Bill goes, yeah, great idea. So now I've got the money, I can invest it in the business, I don't have to pay him back regularly. I do pay dividends, I'll get to that later too. But that was the idea. So once you have this joint stock limited liability company, someone said, well, I own part of it, that's great. And now there's 100 shareholders, pick a number, 100 shareholders. And one of them says, I kind of like my money back. And the company says, well, we don't have to give you your money. You're an owner, but you don't get the money back. The other owners say, well, I don't want your money to be given back from the company because we're using it to grow. And the shareholder says, well, what do I do now? And the answer was nothing until a market for stocks, like a market for fruit and vegetables, was created. All of a sudden, you could exchange your share of that company, hence shares, your proportional share, your ownership in that company with somebody else. And that is a market for stocks. It is a place where people go to buy and sell, like fruit and vegetables, like a fish market, like a supermarket. You go to buy and sell your goods. In this case, you go and buy and sell shares of a company, ownership stakes of a company. That's what the stock market actually is. Now, it doesn't look like that these days, but it should. And that's why I want to kind of make that point, because don't get caught up in the excitement and flashing lights and ego and all that kind of rubbish that happens around the stock market. The people who are gambling money, try and win and lose, and got to buy this, sell this, buy this, sell this. Don't watch the movies and think that's how you have to invest. Investing in the stock market is buying an ownership share of a business. And that's the bit I'm going to go to next. Because when you buy a share of Woolworths, I'm using this example as a matter of course, I don't own any shares. My son owns about 1/10 of a share, I think, in Woolies, but let's assume that's not going to make me conflicted. When you buy a share in Woolworths, what you're actually doing, this is kind of cool and kind of weird and kind of abstract to some people. You're actually literally buying an ownership stake in that company. Now, it's tiny, but let's go back to our 100 owners before, because it's just an easier number to work with. You walk into that market, or in these days, you jump on the internet and you say, hey, I want to buy some shares in Woolworths. I want to own part of Woolies. Why? Because I think Woolies has got a good business. I think I'm going to make money owning shares in Woolies. And you say, does anyone want to sell? And a guy in the corner says, oh yeah, I'll sell mine. Yeah, cool. That's great. Thank you. I'll pay you, what's it, $35 a share? I think for Woolies, I know what the share price is now. I'll give you $35, 35 shekels. He gives you the certificate in the old days. Says, I own one share of Woolworths. You take it home, you put it in the safe or under the bed or live in a safe deposit box, and you are now a shareholder. You hold a share of that company. You own part of that company. Now, that's really important for two reasons. One is I want you to know how the stock market works. But believe it or not, that's not the most important reason by a long shot. Far, far more important is you are an owner in a business. You are not trading stocks. You are not trading shares. You are not reading a chart and saying, oh, the squiggle line says this or that, or it's up or down. You are not, you are owning a piece of a business that I hope if you're doing it right, you're investing in something that's going to create value for many, many, many years to come. Now, we don't hold everything forever, but if you're buying a stake in a business, that's what you should be doing, right? You don't go to the local news agent and say, mate, can I buy half your business? Because I think I can sell it to some other poor schmuck tomorrow for 5% more. You don't, right? You don't go to the local cafe owner and say, mate, can I buy a tenth of your business? I think what I'm going to be able to do is buy it now. And by Tuesday, I reckon the cafe market's going to go up. So I'm going to offload my cafe shares, right? You don't do it. But somehow we've been led to believe, and by the way, you get I'll say nefarious actors who try and make it about that. Why? Because they make money from it, right? You know who doesn't make money if I don't sell my Woolly shares? Everybody. As in, nobody gets a slice. The ASX doesn't get a slice of anything because I'm not paying anything. The broker doesn't get paid. The broker's like, well, you got some shares in Woolies, Scott. Don't you want to sell them and give me a couple of bucks? No, I don't really want to. And yet, everyone's view of the stock market is, if you've seen Wall Street, you've seen the Wolf of Wall Street, God forbid, you see the kind of grabs you see on TV at the New York Stock Exchange where people are yelling and screaming at each other and throwing paper around. That's it happens. It's real. It's absolutely real. But it's not investing. That's trading. That's the I'll say darker side. You can do it if you want, but as we said yesterday or the other day before, day trading is a terrible idea. So please don't do it. But it's up to you. Free world, you can if you want. If you're an investor, you say, thanks for my share in Woolworths, sir. I'm going to take that home and put it under the bed. Why do you take it back out? Well, only if you don't want that anymore. Why wouldn't you want it? Because you need the money. Because you don't like what Woolies are doing. You see it's moved out of groceries and into Bitcoin mining or something. I don't know, pick something. And you go, that's not what I bought. So I don't want that anymore. So you sell it. Someone offers you too high a price is the other reason. So someone says, I'll give you $158 for your Woolly shares. And you think, but they're only worth 35. Sure, you can have, yes, here it is. They're the reasons why you might want to sell. Otherwise, I really, really hope you will be a multi-year investor. I've held some of my shares for at least, I think the oldest one I owned is 18 years. I think I've held that one for, maybe longer, maybe 21 years. Anyway, a long time, right? I hope you're a multi-year, multi-decade investor because that's where the money is created. Why? Because companies do better things over time. If I was more organized, I'd have charts of company profits. Profits of Apple or Amazon shares, or Woolies or CSL or Commonwealth Bank. You'll see them go up and up and up and up and up. If you hold your shares, you own a share of that. You're getting wealthier just because you've sat there and done nothing. And the people at CBA, Woolworths, whatever, CSL, have continued to grow the business, create value. That's how the investor wins. The investor doesn't win by trading. You don't buy it one and try and sell it two. Buy it two and sell it three. Again, you can if you want, but please don't. The investor wins by buying great businesses at good prices that go on to be worth more in the future. That's what the 9% gain I mentioned is all about, right? The market doesn't go up 9% because people buy and sell and buy and sell and buy and sell and buy and sell, and somehow it's worth 9% more. It's worth 9% more because the people at the end of this year think the whole market is worth more than it was a year ago, and that's largely because profits have grown. And that's kind of the key point. So keep that one in mind as well. Cassandra, something I'm putting in a superannuation. Talk about super tomorrow. Hold that thought for me, Cassandra. If you wouldn't mind dropping it towards the end, if I run out of time, I won't. Sorry, if I don't have more time, I won't. Maybe tomorrow on super or maybe on Friday. Sorry, it's just a bit of a left turn. I want to get into more of the fundamentals first. Okay, I talked about indexes before. I talked about the market, actually. And I kind of said I'd come back to that. If you want to know how the ASX is going, how the US market is going, you need some way to measure the change in value. That 9% I told you was exactly that. How do you measure the change in value of a whole stock market? How do you track the success or failure of investors as a group? Yes, you know the price of shares in Woolies goes up or down, but Woolies is one company. Is that good or bad? Is it better or worse than the rest of the market? Has much value been created or not? We have what we call indices. You'll hear called indexes. I'm just a pedant, so I like indices because that's the proper plural of index. Whichever way you want to go with it, indexes or indices is up to you. But an index is basically a way of compiling all of the companies together, or most of them together, and working out a value for the whole lot, and then tracking that value as it moves in time. Now, the easiest way to do it is simply add all the market capitalizations together. That is the market value of the companies. If Woolies is worth, I don't know the number, I should look it up. I'll do that really quickly. Why not? Just for fun, just to prove this is live. Right now, Woolies, according to Google, is worth $37.15 billion. I could add that together with CBA, CSL, BHP, and I say, right, the market is now worth $2.78 trillion. And tomorrow it might be worth $2.79 trillion. And that's completely doable, right? You could do it that way. What they've done instead is create an index. Now, an index basically sets a base and then measures the proportional change in that. Now, I don't know where the ASX 100, 200 started, but let's call it 1,000 points. It almost certainly wasn't. They just picked a random number and said, right, let's assume the current level is 1,000. Could be 100, could be 5,000, doesn't matter. It's 1,000. If the market goes up a bit, those values go up. It's now worth 1,001 points, 1,005 points. And it just allows us to track the value of the market over time. So you'll hear the ASX 200 talked about. That is simply the 200 largest companies on the ASX. Couple of tweaks to that for reasons you don't need to worry about. But effectively, the largest 200 companies on the ASX is the ASX 200. You might hear about the All Ordinaries Index. That was the oldest one. All ordinary shares. Now, I get into ordinaries. There's ordinary shares and preference shares. Ignore that. That's why it's all ordinaries. All of the ordinary shares is the way it was kind of contracted. The All Ordinaries is 500 odd companies. So it's the ASX 200 plus another 300. So you're getting a bigger representation of the market. In the US, the oldest one is the Dow Jones Industrial Average. Not a true index. Don't worry about that either. It takes 30 companies. Again, because it was done like decades and decades ago when they didn't have computers, right? So you need a reasonably representative but small number, so you could add them all together and work it out. So the Dow Jones Industrial Average is the oldest one. You very rarely hear it talked about, at least not as a primary index. The primary one is the S&P 500, Standard & Poor's 500, 500 of the largest US companies. Again, similarly, bundled together and tracked over time to see whether you're making or losing value. So that's what those indexes or indices, as we should say, are. That's what you hear them talked about. When you hear them talked about, you'll know now. They're telling you what the largest 200 Australian companies did yesterday or today. When you see it on the news tonight, if you're watching the news on Lions Late News tonight, you'll see me with the same backdrop, by the way. I do it from here as well. That's what you'll see. So that's what the index is. All right. Rolling through this now. Should we go into... Okay. Why do shares move? It's either an obvious or not obvious answer, and maybe the obvious answer isn't even really the right answer. So let's go through it. We just talked about the fact that the stock market is a market for stocks, same as market for veggies and a market for fish. Let's talk about vegetables, because that's easy. Older people, I don't know how many years ago it was now, too many years ago that I can't remember, and pre-COVID, so that's all a blur anyway. The price of bananas went through the roof. Now, why did the price of bananas go through the roof? It went through the roof because the supply fell and demand stayed constant. We wanted 100 bananas. There used to be 100 bananas provided. The price was $2 a kilo, pick a number. Half the banana crop, I don't know what it actually was wiped out in Queensland with a cyclone, and now there's only 50 bananas. Now, the 100 people still want their bananas. This is, by the way, year 8 commerce supply and demand. 100 people still want their bananas. They're going to pay more, and only 50 people are going to get them. So what you end up seeing is the price goes up to meet the point at which those 50 people who want it the most are prepared to pay. That's why we saw the price literally at the time go to 10 or 15 bucks a bunch. If they'd been 15 bucks a bunch, no one would have bought them. The price would have come back down. So we're seeing the balancing of supply and demand. And at the point at which it meets, they call it the equilibrium point, by the way, for the economists who are watching. They know that, but you do too. That's where you set. That's where your price gets set. So what makes the price of Woolies go up or down? First and foremost, the fact that the buyers and sellers meet at that point. If I'm selling Woolies, the current price is 35, I think I said. Let me see. Oh, no, 30. There you go, 30 bucks. If I want to sell mine for 40 bucks, the market goes, cool, don't care. If I want to buy for 28, the market goes, cool, don't care. And eventually, either I might keep my price there, by the way, and he might keep his buy price there, and we never trade. But if I get a bit more desperate, how about 38? He says, how about 39? This doesn't actually happen in real time. It's the matching of all of the orders that people put in. But effectively, this is what happens, right? So the person who wants to buy at $30.01, the person who wants to sell at $30.02, eventually one of them moves and you make a trade. And that's when the trade gets done. So supply and demand is fundamentally in the short term, the very short term, what sets the price. Now, what impacts that? And that comes down to these other two things, long-term and short-term impacts. Warren Buffett, again, I mentioned him a few times, had a mentor called Ben Graham. He had a famous line. He said, in the short term, the market is a voting machine. In the long term, it is a weighing machine. What is that telling us? It's telling us in the short term, all that matters is the popularity. Now, we've seen, if you watch the Afterpay share price, went from $2 to $150 and then back down again. Plenty of, Bitcoin itself is up and down all over the place. And even normal shares. Woolies, I mentioned before, let's do the last 5 years. The lowest price for Woolies has been $28.94. Got to $42 in 2021. Back down to $32 by 2022, and around and around and around it goes. In the short term, it's a voting machine. I want Woolies shares more than you want to sell them. I'm going to pay you a price until you finally agree to sell your shares. You want to sell them, you really want to get rid of them. I'm like, well, I'm not going to do it unless you give me, unless you sell them for $28. I'm like, all right, fine. You can have it for $28. The price comes down. So supply and demand. In the short term, it's a voting machine. How much do I care? How much do I like it? How much do you like it? And that's why prices are volatile, right? You see this really squiggly line. I talked about the nightly news. Over the long term, those daily squiggles, when you zoom out, get much flatter. There's little tiny little squiggles on the line. And over time, you see the value of the businesses, the value of the stock market move based on the underlying value of the companies. So we go from sentiment, I like it, I hate it, I like it, I hate it, to actually over time, it's going to move towards, there's no perfect value, it's going to move towards fair value. So in the short term, that's what moves share prices. Sentiment and buying a stock. That's literally all it is. In the long term, the fundamentals of the business. Woolies is earning more money again and again and again and again and again. And the more money it earns, the more shares are obviously worth commission. So it goes up over time. That's what supply and demand is. That's what moves share prices. It's also why I really want you, if you're a long-term investor, to ignore as much as you can those short-term movements. Why? Because the short term is short term. They will smooth that over time. I gave the example the other day. The market fell 38% in the month and 4 days from its peak in late February. 38%. And as I said yesterday or the other day, it's back higher than it was before it fell. So what did we see? In the short term, we saw sentiment. We saw fear. We saw panic. We saw just people freaking out, right? Selling the shares, sell. And buyers are kind of like, well, okay, if you're going to give me that price, I guess I'll buy some more. So you always find a price. There's always the same number of buyers and sellers by definition. If I sell, you buy. If I buy, you sell. You've got to match. It's going to be 1 for 1. But at some point, like, well, okay, if you give me that price, I guess I wasn't going to, but I will now. And the share price falls and falls and falls. And at some point, the sentiment changes. Oh, it's not that bad after all. Maybe we did overreact. I might go back in the market and buy some shares again. And you see the share price slowly increase. Now, by the way, it always falls faster than it rises. That's because fear is more powerful than greed. It just is. So you see big, sharp falls and then usually pretty modest increases. That being said, during COVID, we had the fastest fall and the fastest recovery in history, in recorded history. That was just the height of the panic, right? So short-term sentiment, longer term, as I said, the market's above the peak of 2020. Why? Because businesses are worth more than 2020. They've made more profits. Things are brighter. The future is brighter. People are going to pay more. So what we saw was the sentiment in the short term, the value in the long term. That's what sets and moves share prices. Let's one more thing to describe, and then we'll talk about some getting started stuff, which I think hopefully a lot of people are looking forward to. Cassandra. Oh, sorry, Cassandra. All right, cool. I'll try and get back to it if I can. All right. So I talked about indexes before, indices, as I should say before. You can buy, and we'll talk about this a little bit in a sec with ETFs. You can buy an index these days. You can just track that index. You can get your 9%-ish a year. Now, I can't say it's going to happen in the future. I can't make you those promises or guarantees. But let's go back 30 years for fun, right? The market's done about 9% a year since then. If you bought the index, just track the index over that period of time, you made your 9%. I've already talked about that. And so on average, that's the average. Some got more, some got less. So there's lots of ways to invest. Two major ways to invest. One is to buy an index, buy an ETF and be done with it. So you know what? I'm going to track the ASX 200. I'm going to follow the S&P 500. Whatever the US market does, I get that gain in my share price, or it's a unit price it's called, but call it share price. That's the gain I get. I track the market. Less a little tiny bit for fees. That's true, but not much. It's tiny these days. Or you can say, actually, you know what? I could do that. Or I could go and try and find businesses I like and buy them. I could buy the index, or I could buy shares in Woolies or CSL or CBA. Now, I'm using big names because everyone knows them. But a lot of value, by the way, is found in the mid and small cap end, largely because the big companies are very, very well known, pretty slow growers, not a big range of valuation outcomes because, Telstra is going to grow at Woolies going to grow at a certain rate every year. Yeah, now not exactly the same rate, but it's never going to go at 40%. It's never going to go backwards at 15% because it's just one of those, it's a grocery business, right? It's very slow and stable and steady. Occasionally the reported profits do move around, but Sales are going to just keep ticking up very slowly over time. Nice, relatively smooth line. So the range of outcomes isn't very big. A small cap, that big risk, by the way. So don't misunderstand that. I'm not saying just upside, but also big upside. Why? Because it hasn't proven itself. Not many people are watching it. Its valuation is uncertain. All those things are true. So it can mean there is more downside risk if you get it wrong, but more upside risk if you get it right. Whether you go big end of town, small end of town, you absolutely can simply say, I want to pick stocks. I want to buy individual companies because I think if I do that well, I can do better than the average. And again, some people do by definition. Why? Because if the average is 9, not everyone can get 12. Someone's got to get 4. Now, if you're the person who can get 12, why wouldn't you take it, right? It's upside. You have to be careful. You don't want to be the person who tries to get 12, though, and ends up with 4. And that's why they're not equal outsides, by the way. It should be 12 and 6 if I was going to do it properly. You know what I mean? 3% on either side. The average works out roughly that way. So, yeah, if that was what I was trying to do, I could absolutely go and pick stocks. The rewards are huge. I mentioned Warren Buffett before. His letter came out earlier or late last week on Sunday. He's made 19.9% per year over the last 60 years. The market's done about 10.2%. So should he pick stocks? Absolutely. He's very, very good at it. Should others, if they aren't very good at it? No, probably not. They should go with an ETF, go with an index. ETF is exchange traded fund. I'll get to that in a minute. But that's index investing versus, it's called stock picking. I don't like it because it's businesses and it's just picking. It's but it's investing in individual companies. It's a bit more wordy, but more accurate and I think more useful. So you can invest in individual companies. You can invest in the index. They are two choices. You have lots of other options around and about the place. They're the fundamental two choices that an investor has to make, with one exception. You can blend them. You can buy an ETF and then add some individual companies. You can buy some individual companies and add an ETF for diversification. All those things are really useful and worth thinking about. All right. Where are we going? Opening a brokerage account. Cool. I mentioned on Monday, I think it was, that buying shares is not that much different to some combination of internet banking and e-commerce. If you have an internet banking account, I bet you do, and if you've ever shopped online, I bet you have, combine those two together, and that's kind of all it takes to buy and sell shares online. Now, I don't want you to buy and sell too regularly. I said that. You should be an investor, not a trader. But the first thing you need to do is choose a broker. You can still go to a full-service broker, someone in an office around town, and pay $150 to make a trade of BHP shares on your behalf if you want to. If that's right for you, I'm not going to say don't do it. What I will say is you're going to pay a very large amount of money. And if you already know what you want to buy, paying more just for the personal service, again, choose for yourself. Is it worth it or not? I don't know. $150 can buy you, we just said 5 Woolly shares. I'd rather 5 Woolly shares, but that's just me. You can do that. The other option is online. Now, again, like internet banking, setting up an account is really easy these days. When I did it way back in the day, that was 7 printed pages. I think I even had to mail it. I think I had to print it out, mail it in. My first account wasn't with Comsec. It was at TD Waterhouse, now owned by Comsec. So I've been a Comsec customer for more years than I can count. So it's really, really easy to set one up. It feels daunting, right? What is this thing? How do I place a trade? What do I do? The best brokers, don't go with the cheapest, is my recommendation to you. Not because I like wasting money, but because the more expensive ones tend to do a better job of education and support. So if you're brand new to investing, sign one of the big guys. You can always change later, by the way. Sign one of the big guys. When I say big guys, I don't mean big guys. Go and check out the websites. Look at the process. See what they give you of support and customer service, right? See what education they provide on the website. I don't mean about investing necessarily. I mean about using their service, their platform. So do that. There's some great small ones. I've mentioned the other day, I use Comsec, Sharesies, and Perla. I like them all, recommend them all. Different costs, different things, different ideas. They're all very good at doing what they do. So any of those are great. There's others out there too, by the way. I don't mean to exclude others. They're just the ones I use, and I'd rather not recommend something I don't know and don't use. But yeah, check those out. Really, 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 really easy. Jump on the website, have a look, just get a feel for it. Do you like the vibe? Are there resources there you can use? What customer service and support do they offer? As I said, that's your best way to get in. Don't sweat the nickels and dimes. Don't sweat the cents. Focus on the dollars, right? And that is just, do I feel good about this? Does it feel safe? Do I feel like I can use it? Is it simple and straightforward? The answer is yes. You're probably in a pretty good place. So when you buy, here's one wrinkle, and this is going to get a little bit detailed as we go, and I will do it because it's important. Go watch this back. I'll try and talk a bit slower too. Watch this back later if you have the time. So you choose a broker, or you're going to choose a broker. When you buy your share, do you really actually own them? Now, I mentioned before, back in the stock market of the 1600s, the market for stocks, you got handed a certificate. This is my certificate of ownership. It is now yours. And if you have it, you can claim ownership. If you don't have it, then no one cares. Fast forward 400 years and 400 and something years, we're now at a point where they have a great system in Australia called CHESS. Now, it's the computerized holding something settlement system. I can't remember. It doesn't matter. Basically what it is, it's a register of ownership interests in shares. On CHESS, I have an identification number. You get given it, by the way. You don't have to go and get it. The broker will do it for you as long as they're CHESS sponsored. I'll get back to that. It's a 10-ish digit number. And it just says, hey, Scott Phillips is this owner, and this owner owns these shares: 50 Woolly shares, 20 CBA shares, 14 CSL shares, whatever it is. That's what Scott owns under that holder identification number, or HIN. You'll see it recorded as HIN. That's how it works. So that's how we know who owns what. Now, in other cases, well, actually, let me take a step back. A broker can either be a CHESS-sponsored broker, that is, they use the CHESS system, or not CHESS-sponsored. You might hear it called held in street name. In other words, the street name of the broker's name. There is very, very little chance that something goes wrong. But if it does, you want to be CHESS-sponsored. It will cost more. Why? Because the broker has to pay to use the CHESS system. So they will charge you more for brokerage. I am CHESS-sponsored with CommSec. I'm CHESS-sponsored with Perla that I use. Why? Because I want to know that I know if something goes wrong, I have recourse to those specific shares. We've had situations in the past in Australia. Opus Prime, you may remember the name. They went broke and actually took a whole lot of customers' money with them. Why? Because all that money was held in street name. It was pooled together. Now, I'm not saying everyone who doesn't use CHESS is at risk of that, but I'm also not saying it's a risk worth taking. So for me personally, any amount of money, significant amount of money, I would always be CHESS sponsored. Now, I'm talking out of both sides of my mouth. I'll give you one exception here. For my young bloke, I mentioned the other day, he's got $200 in a shares account. That is not CHESS sponsored. Now, why do I use shares? It's not CHESS sponsored. First, it's not a large amount of money. If it goes bust, it's not going to. I don't mean to besmirch shares or anybody else. If there's a problem, I can make him up. I can make him good for the money, right? So he's not risking any money, really. I mean, he is, but yeah, I'll sort it out for him. Secondly, shares allows you to buy partial shares. That is, you can buy a fraction of a share, a tenth of a Woolworths share I mentioned before. You can't do that with CHESS because you need to own a whole share. That's how it works. So up to you with what you do. I would always choose CHESS sponsored, except in that really small case where it's a fractional share ownership. It's just easy for him to do. But again, you choose for you. I like shares a lot. They are good people. They will do everything they can to look after you. They're on the right side of, they're doing God's work. So I don't for a second suggest they're bad people to deal with. You shouldn't own. I said I've got my account for my son with them, but I do prefer CHESS sponsored. Why? It's just better, safer. Yes, I'm paying a bit more for insurance, but that's the thing about insurance, right? Insurance is expensive until you need it, and then it's the cheapest thing in the world. So have a think about CHESS-sponsored shares. Your broker will tell you on their homepage whether they're CHESS-sponsored or not. I'm almost certain. If you're not sure, type in the broker's name in CHESS and see what comes out. That's what I would do personally. It's what I do personally. It's what I recommend all people do. The next thing I want to talk to you about is getting started once you've set up the account. So you've chosen a broker, you've made sure they're CHESS-sponsored, then what? And this is kind of where people really struggle, right? Because all of a sudden, you can buy one of 1,500 or 1,800 investments on the ASX. And if your broker offers US investing, the 5,000 plus companies there. And you kind of go, oh my God, what do I do? What do I absolutely do? I got two thoughts for you. The first is go the ETF route if you want to. That way you're getting everything. You can buy, again, exchange traded fund, sorry. Exchange traded fund is a fund that is traded on the exchange, which sounds obvious. Managed funds traditionally weren't traded on the exchange. Traditionally, you sent them a check, again, because I'm old, or an EFT transfer, and they would send you a statement saying, yes, I've got your money. You now own this many units of my fund. When you wanted the money back, you said, mate, can I have money back, please? Sure, I'll give it to you in a couple of days. A couple of days later, you get a new statement with zero on the account and the money in your bank account. That's how that would work. The new one is you can do it on the exchange using your broker. Super easy, super simple. Just too easy. So why not, right? So that's what exchange traded fund is. And you can get funds that track those indices I talked about before. The ASX 200, the S&P 500, lots of others around the world, and other assets too, which I don't recommend you do. So keep that as a warning. You can buy an exchange traded fund that tracks the ASX 200 and ASX exchange traded fund that tracks the S&P 500. So if you wanted to, with a start, you can start saying, right, I don't know what I'm doing yet, but I want to be invested because I get the idea on my 9% a year on average, if that's what we end up with, I want to invest. I don't really know whether I'll use or CSL or CBA yet because I haven't done that work. But what I do know is I want to have exposure to the market. And with two trades, you can own effectively a representative sample of the whole of the Australian market and the whole of the US market. It's not the entire whole because We know there's 1,800 companies in Australia, only 200 of the 200, ASX 200 by definition, but a representative sample is pretty close. So 2 trades, 2 ETFs, job done. You own the ASX market and the US market in proportion to the amount of money you've put in. That is a really, 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 really smart way to start because it gets you in. You get the upside of the market if and when it goes up, and it does over time, in my experience. I think it still will. So you're investing. You also get some dividends, by the way. From those, when those companies pay dividends, the funds flow those dividends straight through to you. So you get some money. I think they pay them quarterly, actually. Maybe it's half yearly, but probably quarterly. So that's kind of nice, and you've already started. That's the simplest way to get started. You don't have effectively a 2-stock portfolio, but in that you own 700 companies. The 200 ASX companies, the 500 S&P companies. That's a pretty good deal, right? So you're already immediately diversified. You've got exposure to the market. You are an investor. Congratulations. You've done it. You've made it. You have started investing. Please make sure you do that. Then either add more, as I said before, to your ETFs, buy different ETFs if you want to, or start buying individual companies. Look around you. One of the great investors of our time, Peter Lynch, I say our time a while ago now, talked about the scuttlebutt method. He said individual investors have a benefit or an opportunity over the shiny backsides in Bridge Street in Sydney or in Collins Street in Melbourne, because we're out and about. We see people shopping at a local shopping centre. We see what our friends and family are doing. We can use that to say, hey, I think this Woolworths thing, this might be a goer. Take a Lavisa. You might know Lavisa, the costume jewelry trainer. They call it fast fashion these days. There's 1,000 stores nationally. Yeah, internationally. If you've got a child, a niece, a nephew, you might know that. One of the first investments I made on behalf of Motley Fool Share Advisor, the service I run at the Fool, not an ad, just telling you, back in 13 or 14, I think it might have even been 12, was Premier Investments. They still own the Smiggle stationery chain that's absolutely targeted at tweens. So it happened we had a tween in our house at that point, and I knew about it. It's like, this thing is, it's catnip for kids, right? They love this stuff. And that led me to start investing. So lots of ways you can find your best ideas. We won't cover them today, but start with an ETF or individual companies. What's key, what's really, really key, is you diversify as quickly as you can. Why is that? Well, I might like Woolies. And again, this is hypothetical. Please keep this in mind. I like Woolies a lot. I like the business. Let's say I bought the shares. And then tomorrow we find out the whole thing was a front for the mafia. And there were never actually any supermarkets anyway. There were only actually 3 in our suburb. We thought they were everywhere. And the whole thing's a fraud. It goes to zero. And you kind of go, well, bugger, I've lost all my money. That really sucks. That's not going to happen, but yeah. Let's then say you own a bank and the economy tanks and the bank shares fall 20%. You go, this investing stuff sucks. I hate investing. I was trying to make money. Phillips told me to invest. Now I'm losing money. What am I doing? You can play that out across any number of companies. What's the answer? Well, firstly, you want to buy good companies. So try and find quality businesses. But secondly, be diversified. So if Woolies goes broke, you still got your banks. If the banks fall, you still got Woolies. And hopefully lots more besides. The key or the aim is to get to 20 companies in your portfolio as quickly as you reasonably can. Not faster than you can, as quick as you can. Might take a couple of years, that's cool. Build it over time, diversify so that you're not exposed to any particular company, industry, currency, or geographic risk. Company, industry, currency, geography. They're your 4 things to think about when you think about how to diversify your portfolio, and make sure there's nothing perfect, there's no guarantees, but you are as resilient as you can be to individual risks in any of those 4 categories. Really, really important. The next thing I want you to do, so you've opened you've checked for CHESS sponsorship, you've opened your brokerage account, you've bought some ETFs, maybe you've added some individual companies. And by the way, when I say 25 companies, if ETFs make up a large portion of your portfolio, you're really diversified already. So that's great. You don't need 25 ETFs. If the ASX 200 and the S&P together are, I'll pick a number, 20% of your portfolio, 30% of your portfolio, then you don't need as many additionally to that because they're already super diversified, right? So you might only need another 10 or 12. But ideally, 25 individual companies or ETFs, and then a proportional number of individual companies is where you want to get yourself to. Then do a cool thing called dollar cost averaging. It is the worst label in finance because it's just clunky and boring, and no one's ever yet come up with a better one. So we're stuck with it. If you have a better one, let me know. G'day, Peter. Thank you, mate. You have a HIN. Yes, you are CHESS sponsored. You have a holder identification number, is absolutely CHESS sponsored. If you're not sure, again, check with your broker, the broker you use. They will confirm whether or not you're a CHESS sponsor. But yes, holder identification number is a CHESS sponsored number. You won't have a HIN in a street name. You'll have an account number with the broker. They will simply say, hey, we own 1 million shares of BHP across the whole brokerage. 50 of those are yours, Peter. That's how that'll work. They'll have an internal ledger working that out. There is a third option. It's called an issuer identification number, I think it's called. And that's if you bought shares directly off the company and didn't ever use a broker. then it's issuer sponsored rather than CHESS sponsored. So slight difference, but that's the full answer, just so you know, Peter. Thanks for the question. Averaging is a horrible term. It is boring and clunky and whatever. What it basically means is adding money regularly to your account and getting the average price of the shares or the market over that period of time by definition. I buy shares in January, and then in February, then in March, then April, and in May. What does that do? It spreads your risk, it spreads your buy price, and it means you're adding regularly to your investments. You're not saying I'm going to buy everything up front and be done with it. You're not saying I'll wait 15 years till I get the price I'm looking for. You're adding money regularly to your portfolio. Dollar cost averaging, you're averaging your dollar cost is kind of where it comes from. It's awful, but that's what it is. Like diversification, one of the key parts of investing. Here's why. If the share price falls, let's say you're going to invest $1,000 to make my life easier, and the shares are going to be $25 each because I like that. If the share price is $25, you invest your 1,000 and you get 400 shares. Okay, pretty cool. Or is that $2.50? $2.50. 400 shares. How am I going? You get your 40 shares, $25. You're gonna take that money and say, great, I've got that. Thanks very much. My 40 shares, $25, $1,000 done. When the price falls to 20, your $1,000 buys you 50 shares. So you actually end up buying more shares. That's a win. When the share price goes 25 up to $50, you're buying 20 shares instead. Now, yes, you're buying fewer shares, but the share price is higher. What does that mean? It's meant you've bought more shares when the price is lower. Now, the price goes from 50 back down to 40, and you're buying 25 shares instead of 20. So again, you're taking advantage of that dollar cost averaging. Now, of course, in perfect world, we'd say, well, I'll wait till the share price is 25 and I'll buy all the shares then. We don't have the share price ever going to get to $25. And here's the other thing about dollar cost averaging is if you like the business, you want to keep adding to it. Let's take CSL. I don't know what the share price is now. It's through the roof. I will pull it up because it'll help my story a little bit. CSL shares are currently $262.48. Now, you say, well, I want a dollar cost average, right? But the share price keeps going up. What dollar cost averaging makes you do is keep buying anyway. Why do I say that? Well, the share price back in 2001 was $14. And then it went to $25 by 2004. And you're like, but the share price is up 40%. Why would I missed the boat. Now, of course, if they go from $25 to $260, those shares you bought at 25 would have got up tenfold in the preceding period. What did I say? It was 20 years. Tenfold return in 20 years is extraordinarily good. Some people, I hope it's not you, wouldn't have done that. I don't mean anyone in particular, by the way, but anyone watching would have said, I was going from 14 to 25. It's too expensive. I can't buy at that price. That's crazy. It's already gone up. I missed the boat. Don't believe you've missed the boat. As long as the business's future is bright and the share price is attractive, buy the shares. Dollar cost averaging is one way to help you continue to do that over time rather than feeling like you have to buy now. And if they go up, you miss the boat. Or here's the other thing. Sometimes the share price goes down. People go, I made a mistake. I'm not going to buy now. The share price is down. I'll wait till it goes back up. And then when it goes back up, they say, it's too late. I've missed my chance. Emotions will absolutely cripple you as an investor if you let them. Try and keep them to the side. Don't worry about the share price as done. Worry about the business, the price you're paying today, and the future. That's what's important. You're buying the future, not the past. Past share price movements, ignore. They don't matter. Plenty of people, by the way, will sell you trading packages, saying you can draw special squiggly lines on a share price chart and work out where it's going next. Good luck to them. I will humbly disagree. Put it that way. All right. Let me finish off with dividends. Probably finish off, yeah. Oh, man. You want me to do franking, Andrew? You're a brave man at 53 minutes into the session. I'll try. Well, I'm going to do dividends anyway, so let's do that. All right, let's do that. Okay. You get returns in investing from two sources, right? You get it from capital growth, in other words, the share price goes up, or you get it from dividends. Dividends are a portion of the company's profit paid out to its owners. I mentioned being an owner before. One of the great things about being an owner, particularly if you never sell your shares, is you're going to recognize that value by the dividends that get paid out while you are a shareholder. So the company Woolies makes some money. Says, hey, guess what, guys? We made, I don't know what they made, $5 billion last year. Oh, great. Look, what we're going to do, we're going to keep $1 billion of that because we want to keep investing in growth. We're going to put a marketing campaign. We're opening some new stores. We're going to revamp the distribution center. We're going to make money in future, but I need to invest some of that money now. But here's the good thing. I've still got $4 billion left over, and I don't need that money. Woolies says we don't need that. The management says we don't need that money. And because they are owned by the owners, they say to the owners, hey, guys, thanks. Here's some money back. We've got excess profits. We don't need them. You can have them back. That's what a dividend is. It's a portion of the profits coming back to the shareholders, to the owners, as a reward for owning the shares, as a You get not even a reward. It's not like they're being nice to you. You own the company. You get something for it. You get a return on your investment. So capital gains, capital growth, share price gains, they're all the same thing, and dividends. So profit, capital profit and income. Dividends are a great source of market value, share market value, for two reasons. Firstly, it's absolutely concrete cash. I mentioned the fact that share market can be volatile. Dividends are dividends. Once you got them, you got the cash. The cash is yours. You can do what you want with it. It's a great thing to have, right? It pays it out to you. It's also pretty tax effective. Andrew's already mentioned that. Yeah, thanks, mate. Sorry, it's not a bit late now. No, I'm kidding. So when you paid a dividend in Australia for companies that are based in Australia and earn money in Australia, so those things are important. And I won't get the really detailed details of franking. If you get paid a dividend, if Woolies pays you a dividend, when they do, they have for ages. They say, here's your, I'm going to make it up again, $1 a share in dividends, right? Cool, thanks, Woolies. The Australian government says, actually, just you get your buck, yeah, that's fine. But also, Woolies has paid some tax already on that profit. So we're going to recognise that profit that's been paid, and we're going to give you a franking credit. You'll hear it called dividend imputation is the official name. Franking credit is the short version. Either way, they're going to you don't get any money back directly from the government necessarily. They just simply say, hey, here's your dividend. Here's the tax we've already paid on that. Now, when you go to pay your tax at tax time, you say to the taxman, I got a buck in Woolworths dividends. And the taxman says, okay, well, you've got to pay 30 cents in the dollar on that. And you go, okay, I've got 70 cents left. That's earning money, right? That's what we do. Except the taxman then says, but I realize, or you got to tell him, but let's go with it. I realize those Woolies shares, Woolies already paid tax on that. So you still owe me the 30 cents, but I'm going to reduce that by the tax that Woolies has already paid on that dividend. So you get a tax credit. Now, most people still have to pay some amount of tax, but it might be 10 cents in the dollar, something like that. If you win $1, you'll be paid 10 cents in tax rather than 30 cents, a 30-cent marginal tax rate. Why? Because Woolies has already paid tax for you on that profit. And that's really, really, really important. I'm not going to go into the pros and cons of shares versus other assets right now necessarily. Might do it later. Why does it matter? Well, if you get interest in the bank, you pay your tax rate on it, right? Let's say you're a 30% taxpayer because it's easy. You're going to pay 30% tax on that. Fair enough, as you should. If you get rental income from a tenant, you're going to pay 30% tax on that. Yes, you got to take your costs off first, but the net amount, you pay 30% tax on that. If you own art and you're leasing it out, if you, whatever investment you have, Australian shares are the only publicly traded asset that you get a credit from the taxman because the company's already paid its tax. Remember we started at the very beginning talking about limited liability companies? It's a different structure. So the structure's paid its tax already. It's given you the post-tax proceeds, and you get a credit for the tax that's already paid that you can offset against your own taxation. And that makes dividends, the dollar of dividends is worth far, far more, as long as they're franked dividends. I'll get back to that just quickly in a second, running out of time. A dollar of franked dividends is worth far, far more than a dollar of interest, property rent, or anything else. And that's exactly why, because a dollar is a dollar, but that dollar comes with a tax credit. Now, you only get a tax credit for tax paid in Australia. So if you own a company that does all its business overseas, you're probably not going to get any franking. If the company hasn't paid corporate taxes, lost money for a while, there may not be any franking credits available to pay you out. So it does depend. Don't assume every dividend carries a franking credit, but most of the big companies, big in a town, absolutely do, and it's worth a lot more to you than you would otherwise realize. So that's a really, really attractive part of dividend investing. Now, capital gains also carry some tax advantages if you hold the shares for more than 12 months. You might know there's a 50% capital gains tax discount. Now, the tax office officially says you get taxed on half of the gain at your full marginal tax rate. For the rest of us, we just simply halve our tax rate, right? So if you're paying 30 cents, you'll pay 15 cents or 15% tax on capital gains. Both of those are attractive ways of adding and aggregating your wealth, compounding your wealth at tax effective rates. Really, really not as good as super. We'll talk about that tomorrow, but really attractive ways of building your wealth using shares, either for capital growth and or dividends. By the way, a great company is you're going to get both. They're going to pay out, the Woolies pays out some money and the shares are up. I've already talked about that. I'll go back. I'll do CSL because it's in front of me right now. If you bought CSL shares, if you had, I wish I had, in 1999 at $4.67, now $264. So you've got 60 times your money, plus along the way, they're paying a dividend. At the moment, the dividend yield is 1.16% of $262. They're going to pay you about, I'm going to make it up, about $2 a share. So you're getting the growth of the value of your shares, plus you get money that pays out. If the company makes more money every year, or most years that dividend will increase. Not every year, most years it'll go up. So you've got a rising dividend yield that's super tax effective. you've got hopefully a share price that also goes up. And when you sell those shares, if you sell them, and I hope you don't sell them for a long time, CSL shareholders know they shouldn't have sold them, then you get massive gains on that as well. So that is the opportunity for the investor. That is why investing is so worthwhile. I'm really up against time. Can you reinvest the dividends, says Bill? Yes, you can. You can either do it directly with the company. So you can companies have dividend reinvestment plans or DRPs. They have to call them DRIPs, you'll hear them called, but here we just call them DRPs. They will send you a form if they offer it. And rather than getting cash, you get shares instead. So instead of getting $100 from Woolies, you get 3 shares. A couple of things for that. Firstly, actually one really important thing, you still owe tax on that dividend. So please be mindful of that. If you reinvest your dividends, and I think most people probably could or should or would, I'll tell you why I don't, just to put the cat among the pigeons. But yes, you can do it, but you owe tax in that year on the income because it's the income you've earned. If they haven't got the cash, you've said, effectively, give me the cash, but take that cash for you, give it to me and give me shares instead. The tax office says you earned income, you got to pay us tax. So just make sure you've got some liquid money available to do that. The other thing you do with dividend reinvestment, which is what I do, is I have and everyone should, please, when you set up your brokerage account, also set up an investment account. Never touch that for anything other than putting money into. Money never, ever comes out of that, okay? Deal? When you get paid dividends, so when you save money every month, we talked about this on yesterday, put 10% of your money in that investing account and then buy shares with it. When the dividends get paid, tell the broker, hey, I want my dividends put in that investing account. And then when they put it in, you go, cool, money in the account, I'll buy some shares. So you're manually reinvesting dividends. Not automatic. DRPs do it automatically for you, but you can do it manually as well. For companies that don't offer it, or if you don't simply want to, put the money in the investment account and invest that money instead in the shares of your choice. So either way, you're reinvesting the dividends. Please resist the urge, or if you don't think about it, to tell the broker, oh, just whack my money in my regular transaction account, put it in my savings account. I'll make sure I don't spend it. Guess what? We all do. So please have a separate account. Put the money in there when you get paid, and when the dividends go in there, keep them there and invest both those lots of money in the stock market as you get the chance to. Q&A, TTR pension fund selling shares, putting you in attention. Cool. Thanks, Cassandra. I think we're done, guys. We've done an hour and 1 minute. Tomorrow, we are going to do superannuation and long-term growth. I'm going to, if I'm organized enough, bring you a chart, which is my favorite Vanguard chart we've talked about before. I'm going to bang that drum really, really loudly, because the value in investing, there's 3 things that add value to you. There's the amount of money you put away, there's the return you get, and there's the amount of time over which that money is left to compound. The return you get, you can influence a little bit. Good investor will get 10 or 12% rather than 9. That's good. Like, it compounds nicely. That's not even going to be as good as improving meaningfully the amount of money you put away. 100 at 10% or 200 at 9%, 200 is always going to do better. So keep that in mind. On top of that, the amount of time you have to compound, that's better than the other 2 altogether. In compounding for 20 years versus 40 years, it's not just double the money, it'll be multiples of the money. So time in the market, long-term growth is really, really important. All right, we're done. Thank you, Michelle. Thanks for being very kind. I talk directly to the camera. I talk fast, and I try and cover as much as I can in an hour. Thank you for spending that time with me. Day 3, we're done. Well done, Phillips. Please come back tomorrow. We're going to talk about superannuation long-term growth. And then on Friday, I hope you're storing up your questions. I want to have lots of questions to talk about. Otherwise, I'm going to sit here and twiddle my thumbs. And that's okay with me, but it's not as much fun for you, because watching me twiddle my thumbs is not what I would do on a Friday lunchtime. So please come back tomorrow. Go to the website. Please, down below if you can, hit the subscribe and the like buttons. Also the alert button. I'm not sure it's in the right order. The bell, and hit all alerts. Why? It'll tell you we've got, firstly, tomorrow's video, Friday's video, and then we're actually going to roll out some new video content, or revitalize some video content in literally the weeks ahead. So if you're liking this, if you want more kind of investing content from us, that's the best place to grab it. Thank you for spending time with me. Again, I know I said it yesterday. I'll say it every day this week, probably. I appreciate it. Your lunchtimes are valuable. Your time in general is valuable. Thank you for joining. Thanks for sharing this with your friends and family. Have a wonderful afternoon and a great morning tomorrow. Until we speak at lunchtime Eastern time tomorrow, full on.